Okay, so we're letting people file in still for another minute or two. We were expecting a few more. Uh, However, it looks like the number coming in is trailing off, so I'll go ahead and get started. As you can tell immediately, I'm not the good-looking guy whose picture is on the cover. Uh, so I'm Pete Knorr. I'm one of the financial advisors with Bogart Wealth. And James asked me to step in today to talk about discount rates and how they affect your lump sum. Before I get into that topic, let me just introduce Bogart Wealth for the people who might be joining us for the first time. So we are a registered investment advisor. What that means is we do not work for any bank. So there's nothing between us and our relationship with the clients. Our clients have their accounts at Charles Schwab and give us a limited power of attorney to buy and sell things in their account and move money back and forth between their different accounts. So we have about $1.3 billion of assets under management, and I would say 90% of our clients are retirees or employees of major oil companies. And generally, when we say major oil company, we mean ExxonMobil. So we are a fiduciary required by law to put the customer interest ahead of our own and always act in good faith and be very transparent. And we are a fee-only organization. This is not actually all of our team. There's another new member since we had these pictures taken. But you can see we're a small organization, and this is our tax team. With clients are not required to have us do their taxes, but more and more of them sort of like that idea of the seamless tax team. We have 3 locations. Started out in McLean, Virginia, and that's still the major headquarters. Expanded to Houston, and then of course have to have a presence in the northern part of Harris County. So we have now 3 offices, and we can meet with people outside of those offices at their convenience. Our mission is to help clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. So for our clients, if their children need advice, we're more than happy to help. And on occasion, their parents need advice in negotiating the different federal programs. And so we're happy to do that. You can see the wide range of topics that we are happy to help people with. The not so hidden agenda of all of our informational webinars is to convince people that they really want to come in for a one-to-one financial strategy session, because in these webinars, we can only really address generic topics. And a lot of times you're still left with the question of how exactly does this apply to me? And for that, we offer one-on-one financial strategy sessions free of charge, no cost, no obligation. This is one of a series of seminars that we do. Retirement Planning Timeline covers every topic about retirement, but only about 1 inch thick. The rest of these drill down into the different topical areas within the subject of retirement. So retirement income, Social Security, taxes is always an issue, retired or not. Estate planning, NUA, net unrealized appreciation, and other post-retirement strategies, long-term care planning, Roth versus traditional 401ks and IRAs. Again, that's a topic that applies to anybody who's working, not just retirees. And then backdoor and mega backdoor Roth conversions. If you have other topics that are hot on your mind, let us know. All of these topics came from seminar attendees like yourself who said, you know, you really ought to do fill in the blank. And we came up with a seminar for that. So we're always open to new suggestions. Finally, ready to get into the topic for today, how the discount rates affect, and here we're actually using the name, my ExxonMobil lump sum. So if you're not from ExxonMobil, don't leave yet, because a whole lot of what we're going to talk about is very generic. But when we get down into some of the details, they'll be ExxonMobil specific. And by the way, the chat's open, the Q&A is open. So if you want to pop in with a question at any time, feel free. All right, the Pension Protection Act of 2006. The government decided they need to protect us from our pension. But okay, what was this law all about? It was limiting companies' ability to offer a lump sum option. So basically what it says is you have to be at least 80% actuarially funded, or you cannot offer 100% lump sum. Between 60 and 80%, you can offer a 50% lump sum, but not 100% lump sum. And below 60% funding, no lump sum at all. So when people ask the question, is my company going to do away with the lump sum in the future? The answer is, well, if they stop funding, it's gone. Okay. So that is one major part of the Pension Protection Act 2006. It also defined the discount rates that can be used. We'll get into that later. It defines the actuarial table to be used. I'll come back to that as well. It allows non-spousal beneficiaries to do rollovers from pensions. Rollovers, now, last year, they changed your ability to stretch those for the rest of your life. So that's not quite as good as it was back when they did it in 2006. They also had after-tax balances can be rolled over to a Roth IRA. That was new. And that the company match could be diversified. So you might remember the time when the company match, to get the extra 1%, you had to have the company match go into company stock. This law changed that. And then it defined IRA and 401k contribution limits, not that there were no limits before that, but it further defined those. So this act changed a lot of things when it became effective in 2007, but it created two classes of people: those who are bound by the Pension Protection Act and those who are grandfathered from it. There was a 5-year period of implementation, so from 2007 to 2012. And what ExxonMobil did was said, well, if we can grandfather you, we're grandfathering you. So what it basically came down to is, this is the way they worded it: if you're over 50 by the end of 2007, which means 55 by 2012, and more than 10 years of service by the end of 2007, which again, that meant by the end of 2012, you were 55 and 15. Okay. So what that really translates down to is you were born before 1958 and you were hired before 1998, and no breaks in your employment after 1998. If that's true, then you're grandfathered from the Pension Protection Act. So you don't use the interest rates defined in the Pension Protection Act. You use 95% of the 30-year Treasury bond. We'll get into that in just a minute. And you're stuck with the year 2000 mortality table, okay? So the year 2000 mortality, although it says ExxonMobil, trust me, it's only Exxon data. And it's locked in, it hasn't changed. So all of the life extension that's happened in the last 19 years, I say 19 because 2020 is not a life extension year at all, but all of that is sort of missed if you're grandfathered. So the good news is you got the treasury bond rate. The bad news is you're stuck with an old mortality table. For those who are not grandfathered, wait a minute. So I'm still sticking in the grandfathered. Okay. So those who are grandfathered, this is what your 30-year bond rate has looked like over the last 50 years. Wow, long time. Okay, and you can see that they started out really high after the inflation of the 1970s and have gone down, 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 down. Doesn't mean it doesn't go up at times, but overall, that trend is down, 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 down. And if you look at the very end here, you see it hit a lowest point ever where it actually got below this 2% and it's back up. Okay, so how that translates into the discount rate for those who are grandfathered for the Pension Protection Act. So basically, you take the data from, say, the fourth quarter is going to apply to the second quarter. There's always a dead quarter in between for you to be able to calculate the numbers and make your decision, okay? So most recently here, we hit the lowest ever in the fourth quarter of 2020, 1.25. So the 30-year Treasury weighted over this 3-month period of time, that was the second quarter, was 1.38. They take 95% of that and round it up or down to the nearest 0.25%. So it rounded down to 0.25%, it rounded down to 0.25%. And since then, it's been going up. So the second quarter rate will be 1.25. And we don't know the third quarter rate yet. If the data stop today, it averages so far 1.93, let's call it. 95% of that, 1.83, that's going to round down to 1.75. But there's 24 days remaining, 24 market days remaining. So to reach 2.0, it only has to average 2.04 for those 24 days. And if we look the last couple of weeks, it's been above that all the time, okay? This was a 4-day week because of President's Day. The markets were closed, whether you had to go to work or not. But it's been well above that 2.04. So all it has to do is stay where it's been the last 2 weeks for the month of March, and it's gonna be 2.0. So I would bet it's gonna be 2.0. Okay, so everyone else, that means that you were under 50 years old on December 31st, 2007. You are not eligible to retire by the end of 2012. So for everyone else, we're using these segmented corporate bond yields. Okay, corporate bonds are riskier than government bonds because the government can always print money to pay its debt if it wants to. Not a good choice, but they could. Whereas corporations cannot print money to be able to pay their debts. So corporate bonds are always more risky. They always have higher interest rates. I can't think of an exception, always. And higher rates are bad. We'll get into exactly why and exactly how bad in just a few more minutes, but higher rates are bad. On the other hand, you get to use updated mortality tables. And these are released by the IRS every year, but the company's not required to use the most recent one. In fact, they only have to update every 10 years. And the last time ExxonMobil updated was 2018. And, it costs them something to have somebody go in and change all their tools that they use. So they're going to put it off for a while, which is pretty good because mortalities are way up in 2020 for that retiree age group. So they're using the 2018, and it's got about 2 years more life. And we'll get into what 2 years is worth a little bit later. But longer life is definitely good. Okay, so this first affected people retiring after 2012, so in 2013, and that is they're born after 1957 and or hired after 1997. So these are the three segmented rates. Now, I only got this going back to 2013 because that's as far back as the IRS numbers are published. So segment 1 is a short-term bond. It has the lowest interest rates, and it's going to apply for the first 5 years of calculating the lump sum. Segment 2, an intermediate term bond, and it's going to apply to years 6 through 20. So that intermediate term, and it's a higher interest rate. And then segment 3 is the long-term interest rate, 20 plus years. Well, the Treasury Department calculates it for 100 years, but for this calculation, they only go out to 60 because you figure a 60-year-old retiring, no one's ever lived past 120. There is no point using bond yields beyond that. So segment 3 is, let's call it 20-year to 60-year bonds. Okay. Now, what you can see here is the solid lines are the actual IRS data, and the little boxes are our modeling of that. So this will show you how good or bad our predictions are anytime you can see the line. And here's an example where the IRS said segment 3 went up and our prediction said it went down. Okay, so you can see that in the financial panic and crisis months of March and April 2020 that our model went, okay, wasn't that good. We were off by a few basis points. We were not perfect. But other than that, it's been a pretty good run. So these are the actual data right up until the third quarter is just projected for segments 1, 2, and 3. And if you look at these carefully, particularly if we went all the way back to 2013, you could see sometimes these are moving in opposite directions. So I'll give you just right here, this one went up by 2 basis points and this one went down by 2 basis points, or 4 basis points, excuse me. So they can move in actually opposite directions. So it's hard for a person to look at this and say, well, is that better or worse for me? So we calculate this single equivalent rate. And that makes it easier to see. For example, there was no change from first quarter to second quarter, none at all. Or at least it's beyond the third decimal point. And what it looks like for the third quarter is that it's going up. So the third quarter discount rates are based on what's actually happening in the first quarter right now as we speak. So we still have the rest of March to go. And then it'll still take a couple of weeks before they'll give the official announcement. We'll find out how good our estimates were. So what it's looking like is that it's going up almost 0.25%. Okay, so 22 to 23 basis points. And I would say it's not done. It's still moving in that direction. And so it'll probably be at least 0.25%. And unlike the grandfathered rate only moves in 0.25%. These move in single basis points. And we'll get back to, well, how much does that matter? We'll get back to that in just a few minutes. So this is an estimate that we make of that single rate equivalent. And I took the same methodology that we use for calculating it now and said, well, let's see how far back we can go. We could go back to 1997, and you could see once again, there's some wild fluctuations here. These are daily numbers, and they're going to get averaged to get a quarterly number, but still, in the crisis of 2008, 2009, it's really popped up for a long period of time. While, if you remember the 30-year Treasury, it was going down during financial crises. People flock to government bonds, they buy them up, that bids up the price, that bids down the interest rate. And the exact opposite can happen with corporate bonds. And you can see the same thing here. Now, this didn't last very long, but for a short period of time, corporate bond rates were going to the moon, Alice. Now, of course, the moon is still far below where satellites used to be, but okay. We're in a different world as far as interest rates go. And when people say, when will interest rates get back to normal? I have to say, what's normal? So now finally, how does all this affect my lump sum? So the way to think about the lump sum is, it is the present value of the annuity payments that they would expect to make to you if you chose the annuity. And I want to emphasize what's at the bottom of this slide, because we get questions from people after these seminars that tend to indicate that they sort of missed this. And that what we're covering on this page is a simplified example to illustrate to you what are the impacts of your age when you start, the life expectancy, and interest rates. And using this methodology will get you really close to the right answer. It'll get you within 1%. But remember, the 1% of $1 million is $10,000. And so people really expect, get me to the penny, or at least get me to $1. Okay, that's a lot more precision than this simplified model is going to do. So then people say, well, how exactly do you do it? And well, I can show you, but you really don't want to know. You have to get into the actuarial science and how you calculate life expectancies, and it's ugly. So let's just stick with the simplified and say we're going to get you within 1%. And if you want an exact answer, get a benefit statement. And then let us show you what's wrong with the benefit statement, because they make certain assumptions in it that, of course, aren't true. But okay, so let's go with our very simplified model. Someone retiring at age 60, and their life expectancy is 84.000. They're going to die on their 84th birthday. Okay, so we don't need to calculate the year in which they turn 84 because they're dying. Okay, so basically, and we're doing this annually, even though it's a monthly annuity. Okay, so it'll fit on the slide for you. So basically, and we're back calculating, by the way. We want a nice round even number for the answer. So to get that $1 million annuity lump sum, they would have an annuity of $4,581.89 per month, which gives us $54,983 per year. And we're expecting them to receive that for 24 years. Okay, for the first 4 years, you're kind of answering the question of how much money do I need to put into a bond that pays a 0.52% interest rate in order to have the $54,983 available at the end of the year. And there's your answer, okay? And you do that same bond for 5 years, so you're getting a lower amount each year, but not by much. I mean, this bond's not paying much interest, right? So after 5 years, it's only discounted about 3%. But look at the big difference between year 5 and 6. So a whole lot of people who are used to doing interest rate calculations are just going to take the discount factor for this year and apply one more year discount at this rate. They're not going to get this number because that's not the way this works. The way this works is, how much money do I have to put into a bond that pays 2.29%, so that 5 years from now or 6 years from now, I will have the money to pay this annuity. Okay, and there's the answer. It's a 13% discount factor. You only need about $48,000. Okay, and this keeps going. It's the same bond for 15 years. And then we switch to the segment 3 bond. And so we have another big jump down in the discount factor. And notice that these last few years are only worth about half of what the first few years were. Okay? You're like, why is he making that point? I'm making that point because one of the things we're going to talk about in a few minutes is, if you retire before 60, should you put off taking the lump sum? And I'm going to come back to the idea that these last few years are only worth half of what these first few years are worth. Okay, I'm going to come back to that. So, as it says, we're applying segment 1 to the first 5 years. It's always the lowest, so there's always smaller discount in the first few years. Most of these years are using segment 2. So if someone was to ask me what's the most important of these 3 numbers, it's obviously segment 2. They're all important, but segment 2 is the one that's going to come closest to giving you what is that average one number that I could use to compare this quarter with last quarter. Okay. So now what happens when interest rates change? So this is a continuation of what we had on the previous page, the person getting $1 million lump sum, and with these being the base interest rates. Now, if interest rates go down, the value of the lump sum goes up. Okay? It's sort of like at the store, you want a high discount because you're buying. But in this case, you want a low discount because you're not buying. Okay, you're the opposite of that. So you want lower and lower interest rates are going to make the lump sum go up higher and higher. And this rule of thumb, I came up with this rule of thumb in 2007 when I was explaining to people the impact of the 2006 Pension Protection Act, and saying that on average, corporate bond rates are 1% higher than Treasury bond rates, and that's going to be about a 10% change decrease in your lump sum from that factor, okay? Why am I bringing up when I came up with this? That this rule of thumb is probably going to be good for the rest of your life if it's covered that period from 2007, before the financial crisis, all the way to today. It's been pretty drastic changes in interest rates, and yet that 1% equaling 10% is not far off. With these very, 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 very low interest rates that we have today, the 1% is actually a little more than 10% in the downward direction, and it's a little bit less than 10% in the upward direction. But that's a good rule of thumb for thinking, how much of a change does 1% change in interest rate make on my lump sum? About a 10% change in your lump sum. Okay. Now, what about people who are not yet 60 and considering delaying taking their pension? And so when should a person delay? So first of all, if you need the money right away, it's not a good idea to delay. Okay, so first of all, you have to have passed that hurdle that you have other money to live on for the period you're going to delay, and particularly if you're retiring before age 60. And why is that? So you know, I think, that if you're retiring before age 60, that your pension is going to be reduced by 5% per year, right? Everybody has that in their mind. And therefore, if you retire at 55, you're only getting 75% of what you would get if you waited till 60, right? Well, I'll tell you that's not exactly right. Okay, it's right if you're taking the annuity. That 5% a year reduction is 5% less on the annuity. But the lump sum is the present value of the annuity. And if you retire and start taking the annuity in your mind, this is a mental exercise, start taking the annuity at 55. It's a smaller annuity, but you're going to get it for about 5 extra years. I say about because every year you don't die, your life expectancy goes up. In this range, it's about 1 month per year, okay? So you'll get an extra, let's call it half a year's worth of annuity payments. If you, not really, you're going to get 4.5 years extra annuity payments if you start at 55. Let's put it that way. Okay, but let's forget that for a minute and just say you retire 55 and you start the annuity at 55. The annuity is smaller, but you get 5 years more of it. Okay. And when do you get those? At the beginning or the end? I know it feels like the beginning to you, but if you think in terms of this table, and the table starting at 55, you're at segment 1 between 55 and 59. At 60, you're now at segment 2. Segment 2 continues until you're about 75, and then it goes to segment 3. Okay? So you've added those 5 years at the end of this table when they're only worth half of what they were at the beginning of the table. So those 5 extra years are like 2.5 extra years in present value of the lump sum. And therefore, 5 years out of 25 years, no, 2.5 years out of 25 years is 10%. So you did not get a 25% reduction in the lump sum. You got a 15% reduction in the lump sum, or about 3% a year. If you didn't follow all of my hand waving math, that's okay. What I want you to remember is if you take the annuity, it's 5% a year less. If you take the lump sum, it's 3% a year less. So this was in the discussion of, would you consider delaying the pension? 3% a year is what you're going to get increase in the lump sum just from the delay itself. If interest rates are falling, you will get more. But if interest rates are rising, you will get less. And so how much of a change in interest rate would it take to offset the 3% a year that you're getting by waiting? And the answer is going to be right in this range, right? So rule of thumb is you can afford about a 0.25% change. It's 30 basis points really in interest rate increase, as we're really looking at this side of it. About 30 basis points of interest rate increase is going to offset your delay. Okay, so that's what to take into mind. So generally speaking, what we tell people is if you're not yet 60, in particular, if you're not yet 59.5, wait. If interest rates are flat or declining, you win. If we see interest rates starting to go up quickly, take the lump sum. Don't look back. Okay. This is a roadmap that we put together for people who are going to retire based on what is their benefit commencement date and what do they have to do in different dates. And we have two versions of it, this really beautiful, colorful, interesting version and this really ugly but more detailed version. And I'm sorry, I'm an engineer by nature. I like this version better. And I like to start up here at the top right that says, when is it you're expecting to get that check? If you're expecting to get that check on June 1st, then the paperwork has to be into the benefits office at least 35 days prior to that benefit commencement date. 30 of those days are a federal law requirement. And the 5 is, well, that's good old ExxonMobil belt and suspenders. But if we're going to be kind, we would say it's in case there's a small mistake that can be easily corrected in a couple of days and it won't violate the 30-day federal requirement, you'll still get your check on time. Okay. So you got to back up from that and say, well, if I'm going to get it to them 35 days in advance, then I guess I need to receive it. Need to receive the package and have it notarized and all of that good stuff before that 35 days. So how long does it take between the time I ask for it and the time I receive it? And the answer is 4 to 7 weeks. In this one, we showed it as short as 3 weeks. I guess that's possible. 4 to 7 weeks is what they will quote to you. And I will tell you that if you've been divorced, you better have a copy of your divorce papers. Even if you already gave it to the benefits office, trust me, they will go through the game of saying they're looking for it in Curitiba and they won't find it. So have another copy of your divorce papers, whether you have a quadro or not. They're going to send those divorce papers out to a third-party law firm to review them and say whether you have a quadro or not and what the quadro is and how to interpret it, etc. If you've never been married or you've only been married once, then it's going to be closer to that 3 to 4 weeks between the time you request the intent to retire package and the time you receive the benefit commencement package. So it's kind of funny, the name changes between the time you ask for it. When you're asking for it, it's called the intent to retire package. When you receive it, it's called the benefit commencement package. Okay. And the other thing along with requesting the intent to retire package is informing your supervisor in writing. Doesn't have to be too formal. Email's good enough. And what I suggest to people is copy your timekeeper on that email and request the supervisor to instruct the timekeeper to start the SMART form. So that SMART form is really important, and that's kicked off on the supervisor's side, and you requesting the intent to retire package does not kick it off. So even though you requested it from benefits and the SMART form is processed by benefits, you need both sides of that equation to happen. All right, that kind of begs the question. No, that's not really begging the question. It asks for the question to be asked. What happens if I get this thing in late? Well, your check will come in late, but you'll still get the benefit commencement date you asked for. So let me give you an example. Somebody who wants the benefit commencement date of June 1st, but they don't make up their mind about it until like the middle of May. And even then, they don't request the intent to retire package until late in May. Can they still get the June 1st discount rate, even though their package is not going to get to them probably in the month of June? And the answer is yes. They will still get the discount rate that they requested, even though there's no way for this paperwork to happen in the time frame for them to get the check by June. They might not get that check till August. And the company will give them a little bit of interest for it being late, but they will get the discount rate that they asked for. Okay, so what should you be doing now if the things that we talked about are something that really matters to you? So the most important thing for a retirement plan is your budget. The most important thing is the budget. People usually put a lot of effort to getting us their assets and the details of the assets. That's good, that's important. Maybe their Social Security numbers, a pension projection, all of those are good. Good, definitely need all that. But the budget is the thing that is the absolute most important out of everything. Understanding your cash flow needs and when you're going to need them. Will you be able to afford to delay the pension if you're not yet 60? And then also understand what is your risk profile going to be in retirement. Are you going to be able to sleep at night with the normal market fluctuations, or do we have to put together something to sort of protect you, particularly your psyche, from the ups and downs of the market? Okay, so those are the things that you can do now. And of course, we'd love to put together a plan for you. Again, no cost, no obligation, to help you sort of see how these different factors fit in. You know, maximizing your lump sum is not the same thing as maximizing your retirement security. It's just one factor of understanding how these pieces fit together to really see how do you maximize your retirement security. And that's everything I had for today. Not too many questions came in, but I see a few people came in since I introduced myself. So normally James has done this presentation, and he asked me to step in today, and I think I'll be stepping in for this topic in the future. We've also been doing this in the first week of the month, but the IRS publishes the number from the previous month in the middle of the month. And people are usually very anxious to know, okay, so how does this latest number affect me? So we're thinking about moving this to the third week of the month. Okay, so what do we think are going to happen with interest rates basically for the rest of the year? So this is for somebody who is thinking of retiring in 2022. And so let me go back to where we were on this. And so far, what we've said is we hit this all-time low for the first quarter. It rolled over to the second quarter. And at this point, we're projecting the third quarter to be up about 0.25%. And interestingly enough, the segment one, the short-term bond yield, the one that's most closely controlled by the Federal Reserve, is still going down. But these other ones are going up enough to offset that. And why is that happening? That's happening because the prospects for the economy look better and better, right? As more vaccines roll out, as we come off of that terrible high in new cases and number of people in the hospital, which is much more important than the number of new cases and the number of deaths. They were all way, way high going into the holiday season and coming out of the holiday season, and they dropped way down, 60% declines in most of those horrific numbers. That is leading to a little bit more opening of the economy. You know, we know what Abbott said yesterday, for example. So more opening of the economy, which there's a lot of shortages showing up. So there's demand, but not all the factories are up to speed. So shortages leading to price increases, leading to inflation expectations, leading to higher interest rates, particularly on the long end, right? This is up 30 basis points from where we were last quarter to where it looks like we are this quarter. And as I told you, if you look at, where was it? Oh, no, I'm sorry. That I didn't have it for corporate bonds. I only had it for treasuries, saying that, you know, look how much this has gone up just in the last 2 weeks. Well, corporates are basically doing the same thing. Going up every week, we see higher numbers. A week ago, we were saying this would be up 10 basis points. It's now 20 basis points. I mean, that's a lot of change in 1 week's perspective, and we still got the whole month of March to go. So if these predictions are correct, well, this number is going more like this number, okay? More like a whole percent increase is possible between now and the end of the year. I'm not predicting that, okay? But if I'm predicting a quarter point for 1 quarter, and somebody asked me what's going to happen in 2022, I would say it could be up a whole point. Now, what could make this wrong? What could change that? Well, there's a lot of people worried that the stock market is outrun its headlights, that corporate earnings are not high enough to justify these prices. I can go on a long dissertation about that. But let's just say that notionally, sooner or later, that is right. If earnings don't come up enough to justify these current stock prices and interest rates go up, there's going to be hell to pay. And if the stock market starts cratering, based on history, we would expect the Federal Reserve to come in and with fire hoses and blow more liquidity into the system. And that means interest rates go down, unless, of course, the bond market revolts and says, you ain't fooling me this time, and long-term rates keep going up. Okay, so in short, I expect 2022 to be higher, as much as 1% higher. I wouldn't go so far as to say 2% higher. That's that I think is out of the realm of realistic. Not out of the realm of possibility, but out of the realm of realistic. And if we look at kind of what the historical numbers have been, and again, ignore this. This is a daily thing, and we need to average over a quarter to get the number. But, you know, could it go back up to being around 4.5% as opposed to being down here closer to 2? Yeah, of course. Yes, it could. But that is generally going to take years to do that, not 1 year. So if you kind of look at the last low here, was at this point in time that affected retirements in early 2017. And then, you know, this is early in the Trump presidency when everything was getting better until it didn't. Okay, so let's see. So someone's asking the question about if you retire at less than 60. And so let me see if I can, summarize what I said earlier, which is that if you start the benefit before age 60, the annuity is going to be reduced by 5% a year. So if you take the extreme and say you started the annuity at 55, you've got a 25% reduction in the size of the annuity. That does not translate into a 25% reduction in a lump sum because you've started this 5 rows earlier. You've got 5 years before you get to age 60, and your life expectancy is not much different. So instead of 24 years, you're going to get the annuity for 29 years. The years you add are going to be years at the end, so they're only worth about half of what years at the beginning were worth. So instead of calling it 5 extra years, I say it's equivalent of 2.5 extra years out of about 25 years. You get 10% more present value, but the annuity was 25% less. So the net change is 15% less at age 55 or 3% per year. And this is exactly why we tell people to, if you're not yet 60, consider putting off taking the benefit as long as interest rates are stable or going down. Okay, so question is, well, if I'm using the ExxonMobil pension calculator, what's it going to show me? I'm telling you exactly what the pension calculator is going to show you, because what I'm saying wouldn't be worth anything if it didn't match the pension calculator. So the pension calculator will show you for every year you retire before age, or take the benefit, not retire, take the benefit before age 60, it's going to reduce the annuity by 5%. And it's going to be very precise, and it's going to do it to the month, to 4 decimal places. That it will reduce the annuity by that 5%. But then if you look at how much the lump sum changed, it'll show more like 3%. Now, of course, you can run projections and say, well, what if I retire at 55, but don't take the annuity until, I don't know, 58, 59, 60? They're free, run as many as you want. And this is where you should see that 3%. If you say I'm going to work longer, well, that's different. If you're going to work longer, you also have more years, right? And so let's say somebody started at age 22, they worked till 55. So they've got 33 years of experience. If they say I'm going to work 1 more year, that's another 3%. It's 1 year out of 33. So 34 is 1 plus 3% of 33. That's going to make the annuity go up by that amount, and it will make the lump sum go up by exactly that same amount. So for somebody who's 55 and looking at working for another year, it's an 8% bump up, not a 5% bump up for that reason. And of course, if you think you're ever going to get a raise again, then working has even more benefit for you in terms of the pension calculation. And this is one of those places where the pension estimator is wrong. It makes a really dumb assumption. It makes the assumption that the day after you run this number, you're going to get a pay cut. So in other words, if your actual salary is higher than your average for the last 3 years, and you're going to work another 3 years, as long as you don't get a pay cut, that in 3 years, your pensionable pay is equal to your current benefit pay. However, the tool doesn't assume that. You know, I always imagined that the person programming that tool had a lawyer whispering in their ear, assume we can cut their pay anytime we want. And anyway, so it makes that really silly assumption, which you can try to override by forcing in salary increases into the tool. But what I would say a better way is just let the tool do what it does, bring the numbers to us, we'll show you what reality is more likely to look like. If there's no other questions, I'm like right at the end of my my time contract. So let me just say, love to see you at our upcoming events, the next three: retirement income planning, long-term care planning, and estate planning. And we would love to see you at a one-to-one financial strategy session and take any of these questions and apply them to your situation. Thanks for attending. Here's how you can contact me or any of the other advisors or Mindy, who schedules all of our calendars for us.